the inheritance tax, the estate tax. After you die, the government comes in, and if you have a sufficient amount of money, they basically take half of it. The inheritance tax is probably the single worst tax we have. Now, what am I talking about? Because when most people talk about the estate tax, they say, oh, it's just for the rich, right? Because only 2 out of 1,000 actually pay the estate tax. In reality, the super rich don't even pay that big an inheritance tax because they use the tax code, they use the loopholes, they use complicated and expensive structures and trusts that involve lots of lawyers and accountants, and they devise ways around the tax. The people who are most likely to pay the estate tax are the smaller businessman. Guy owns a business, maybe he has a couple of partners, not a publicly traded company, privately held business, right? Let's say that business is worth $50 million, right? Because the estate tax kicks in, I know, somewhere above 10 million, right? So let's say you got a $50 million business, you got a big estate tax coming. Well, if a business is worth $50 million, that doesn't mean that there's a $50 million pile of cash there and you could just peel off 20 million and give it to the IRS. A lot of the assets are not liquid. Some of them are non-cash. Let's say you have goodwill. That's your reputation in the marketplace. I mean, you can't sell that really. I mean, it's not a physical, tangible asset. It's intangible, but it has value. You get taxed on it. But then you have property and equipment that you need to operate the business, right? You can't really just liquidate that. Maybe you have some inventory, but you need that. There's probably some receivables, which you don't actually have the cash. I mean, so how much cash does it actually have? Probably not much. So what happens? They've got to sell the business to raise the money, to pay the tax. And who is the most likely buyer for a business where the principal owner just died, right? Who's most likely to buy it? Who's probably going to give the heirs the most amount of money? A larger competitor, right? He's going to outbid anybody else who wants to operate the business independently. Why? Well, because the larger competitor sees an opportunity to take out a competitor, right? That's good. Less competition, easier for me. Raise my prices, charge the consumer a little bit more. That's number one. But number two, you're going to have economies of scale. You're going to have synergies. You're going to be able to take a lot of the revenue from that business and just add it to your revenue and get rid of a lot of the expenses, a lot of the overhead. What is usually the biggest overhead? Wages, the labor. So what happens is a guy dies, and now because there's an estate tax, the business has to be liquidated to a larger competitor, and all of the workers get fired. Yes, the heirs still end up with a lot of money. They still get a big payday, right? They still make a bunch of money. They don't make as much money, but they still get a check, right? But their employees, the workers, they get a pink slip instead of a check. In fact, one of the biggest advocates of the estate tax is the hypocrite Warren Buffett. And why does Warren Buffett like the estate tax so much? Because he gets to buy up a lot of these businesses where the owner dies and now they can't afford to pay the estate tax. See, he's the big business that gets to gobble up the competition. He grows his market share and can charge more money, right? So that's the part of the hypocrisy of Warren Buffett.